Hello, welcome to ibbusinessandmanagement.com. I'm Mr. Burton, and today I'll be running you through another section in this IB Business and Management course. We are in our account and finance topic. We're in the fifth installment. Just one to go after this. Our fifth installment. Today we're looking at financial accounts, and we're doing something a little bit different with our financial accounts topic. We're going to split the whole thing up into four different sections, each targeting a key skill. Today, and the first thing we're going to look at is the income statement. Next, we'll go into the balance sheet. Third, we'll look at depreciation. Depreciation, that is if you are a high-level student. And fourthly, we'll look at stock valuation methods, the infamous FIFO and LIFO type things. But today, 3.5 financial accounts, we are focusing on the income statement. Hope you learned something. Okay, the income statement, the main part of the income statement is called the profit and loss account. And the whole idea behind this is to show the amount of profit or loss that a business made during a particular trading period. Typically, we're talking about a year. So the amount of profit that a business made, very interesting financial information, very critical for key stakeholders to know this sort of information. What does it look like? The trading account is all about profit and loss. So we get some key figures coming through here: gross profit, net profit before interest and tax, and net profit after interest and tax. All very, very key things that any stakeholder in the business is going to want to know. So the income statement is divided up into three parts: trading account, profit and loss account, and the appropriations account if we are talking about a public or a private limited liability company. Trading account and profit and loss account are the main ones. Trading account, sales revenue coming in, and we subtract the cost of goods sold. So we're talking about direct cost of what we're producing and selling here. This will give us a gross profit. After that, we can look at the expenses, our overhead expenses, things like salaries that are not directly related to the cost of goods sold, electricity, wage bill, utility bills, etc., etc., etc. If we subtract those from our gross profit, we end up with net profit before interest and tax. Now, the business may well be paying interest on debentures they've issued or long-term loans. Then tax is subtracted off the top of that as well. So every business, if they're making a profit, presumably if they're not lying away in some safe tax haven somewhere, they're in a normal developed country, they'll be paying some sort of company tax. Here in New Zealand, companies will be targeted at, I think it's about 28%. 28%. That may have changed just recently, actually. From our net profit, after we've paid our interest, after we've paid our tax, then we've got two things we can do with our money. We can pay it out as dividends to our shareholders, and reinvest any profits that we may have made in the trading period back into the business, so retain profit. Right? After net profit, after we've paid our interest, after we've paid our tax bill, what are we going to do with our money? We'll pay it out to our shareholders and or plough some back into the business. That's done in what we call the appropriations account. It's very unlikely in the IB Business and Management exam that you're going to have to construct a whole profit and loss account. You're typically given the structure, and just a few changes or calculations are going to be required by you. You're not going to have to prepare a full set of accounts.
Aw, crap. Aw, crap.
Just some key calculations that we can pull from the profit and loss account. We'll look at this more in the next section. Sorry, the section after this, when we look at ratio analysis, but gross profit and net profit margins here can be calculated as a percentage of sales. Now everybody wants to know what sort of profit margins a business is making. So gross profit, we'll have a look at our gross profits and we'll look at that as a percentage of sales revenue. Net profit, we'll look at that as a percentage of sales revenue as well. Key figures those, but we'll come more to them at a later stage. A typical sort of exam question here, where you've given the profit and loss account. In this case, we've been giving a whole income statement, a whole profit and loss account, and we've got to go through and calculate some missing values. So we know, let's have a look at the first one there. Our first question mark is next to sales revenue. Now we know sales revenue minus the cost of goods sold will give us a gross profit. So what minus 200 gives us 250? 450 does. Gross profit less our overhead expenses will give us our net profit before interest and tax. Our net profit before interest and tax is $90,000. Our gross profit $250. What's the business burning up in their overhead expenses? $160,000. And last but not least, no, it's not last. Sorry. Our net profit after interest and tax. Interest will be subtracted from net profit and then tax after that as well. So 90, subtract 15, subtract 20. What are we left with? $55,000. Looks like the business is paying $30,000 out of that money to their shareholders and keeping the rest in the business. How much are they keeping in the business as retained profit? 55 minus 30,000 dividends will leave $25,000 to be invested back into the business. So a nice logical structure. You just need to know the structure and the key calculations. So gross profit, net profit before and net profit after, and then dividends and retained profit coming through. So know the structure. The calculations are dead easy. Another exam question, May 2010, calculating missing values again, a gross profit and expenses figure in 2009, cost of goods sold in 2010, and net profit before interest and tax in 2010. Now, how's gross profit calculated? We've run through this already. Sales revenue minus cost of goods sold, so $2,800 minus $891. 1909. Now from that gross profit, to get our net profit before interest and tax, we have to subtract our expenses. So 1909 minus what will leave us with 644. $1,265 is the answer there. Across quickly to 2010. We know again that gross profit's calculated sales revenue minus the cost of goods sold. So 3123 minus what is going to leave us with the gross profit of 2,131. 992. Net profit before interest and tax. We know how that's calculated. That's gross profit less expenses. So $2,131 minus 1,453 will leave us with 678. And that would be, I think that was two mark question in May 2010. Pretty straightforward calculations. A case study question in our textbook. Run through this quickly. One of the required. Here we are actually going to go through and prepare a whole income statement, just to make sure you know exactly what is going on. It's important that you've got this skill because there are key parts of different income statements that you may well need to be able to pull out the key information and construct parts of it. So let's have a look. We're given some key information here. Dividends are being paid $60,000, cost of sales $250K, overhead expenses $100K, Sales revenue coming in 500k. They're paying company tax at 20%. A nice lenient tax regime there in this country. And it looks like they've got substantial long-term or debentures, being long-term loans or debentures. Their interest bill is quite high at 50k. Okay, so again, structure. This is what you need to focus on remembering and practicing. Once you've got the structure, everything else just falls straight into place. Sales revenue, cost of goods sold, gross profit, overhead expenses, net profit before interest and tax, interest, tax, net profit after interest and tax, dividends, and any retained profit. Right. If you can throw those down, you'll be able to answer any sort of income statement, profit and loss question that comes your way. Now we know it's 2012 and we know that we need to put some figures. Sales revenues given at 500k, just plug it in. Cost of goods sold, information is given there. Cost of sales, they're trying to disguise it a little bit, 250k. Now, again, brackets, standard convention brackets will be indicating a negative value. So cost, that's money flowing out of the business. So 500,000 minus 250,000 will give us our gross profit, our first calculation. Overhead expenses, we've identified them as overheads right here. I plug the number in, 100,000 comes in here. Again in brackets because it's negative, it's money that's going out of the business, cash that's flowing out. We can calculate net profit before our interest and tax comes into play. 250 minus 100. Net profit before interest and tax, $150,000. We are paying interest, $50,000 here. That will go in, cash outflow in brackets. Now tax, we are going to have to do some work here, and we're not given an actual tax bill or the tax or the actual dollar amount that the company's going to have to front up with. We are given a tax rate, so we're going to have to figure out what monies we are going to apply the company tax rate to. Net profit before interest and tax. So we are paying tax on our net profit. Interest is an expense, so we're not paying tax on that. So essentially we are paying tax on 100,000. So net profit after interest payments, which is 100,000. We'll pay tax on $100,000 net profit after interest. Now that's at 20%, so that's not hard to figure out. 100,000 at 20%. We're going to have to pay the government $20,000. And after that we can calculate net profit after interest and tax. 150 minus 50 minus 20, 80,000. We have got a dividend figure. We've been told how much of this profit is being paid out in dividends. We'll just plug it in. Again, it's a negative number, it's in brackets. We're not given a retained profit, but we know that if we're not paying a net profit after interest and tax out in dividends, then that money is necessarily remaining within the business. So retained profit of 20,000. Done, dusted, easy. The calculations are easy. Again, I repeat it, and I'm repeating myself to death here, but students get it wrong a reasonable amount of time. The structure is what you have to focus and memorize. Everything else falls into place once you've got that. The numbers you're plugging in, the calculations are easy, easy, easy. It's the structure. Oh, and just quickly, if we're asked a question where we need to identify what parts are which, sales revenue, cost of goods sold, gross profit, that's our trading account. The profit and loss account, right down to net profit after interest and tax, and the appropriations account, just that remaining dividends, retained profit part. Right. If we're asked to identify which parts of the trading account, which parts of the profit and loss account, which parts of the appropriation account, we can do that quite easily. Another exam question. We are going to run through the structure. We're given the information up the top there. So we're talking about a business. Shop sale average $80,000. Now this is for each month in 2012. The shop sales average 80k. Cost of goods sold, we have to do some calculations there. No problem. We'll deal to that in a minute. Indirect costs, monthly again. Monthly interest on long-term loan, company tax at 15%, and a van has been purchased in February for $40,000. Right, we know our structure. We'll start with that. Let's throw it down. It doesn't change. The structure doesn't change. Once we've got our structure in place, we'll just part of our table under the heading 2012. What's the first thing that we're going to have to do? We've been tricked. The tricky IB business and management examiners who created this exam threw in this red herring. A van has been purchased in February for $40,000. Now, you and I both know that a van is capital expenditure, and capital expenditure has no place at all in an income statement or a profit and loss account. A red herring, we've identified it. We'll ignore that. After that, the tricky little part has been dealt with. Sales revenue, there we are. Everything's multiplied by 12 because we've been given monthly figures and we're constructing a yearly income statement. Cost of goods sold, so all we're going to do is take that 960 and multiply that by 0.75 to give us 720k. In brackets, it's negative, it's cash flowing out of the business. Gross profit, sales revenue less cost of goods sold, 960 minus 720. 240k is our gross profit. Overhead expenses, let's have a look up the top here. Indirect costs, they're trying to change terminology a little bit. We're not fooled. Indirect costs, we know that's the same as overhead expenses. 10,000 a month, 10,000 times 12, 12 months in a year, 120,000. Subtract that from our gross profit and we've got our net profit before interest and tax, 120k. Interest, that's up there somewhere. Monthly interest on a long-term loan, $5,000. $5,000 times 12, 60 grand. We know that we're not paying tax on the full $120,000 there. We don't have to pay tax on our interest expense. So we're only paying company tax on $60,000. 120 less 60 leaves us 60. 60,000 multiplied by 0.15 will leave us with a tax bill of $9,000. So $9,000 cash that flows out of the business into the government's coffers. And we can finally calculate our net profit after interest and tax. 120,000 less 60 less 9. Net profit after interest and tax, $51,000. We're not told what the business is or if they have shareholders, what they're going to do with their money. So this is an income statement less any appropriations that are going to be made. Again, easy. What do you have to know before it all clicks into place? You have to know the structure. Trading account, profit and loss account. Not a complete income statement because we are missing the appropriations account. Almost at the end. Often with these income statements, profit and loss accounts, we're going to have to identify the benefits and limitations of each.
Show me.
Okay, the advantages of the profit and loss, the income statement. It's important as it shows the profit, if there is any profit, after all costs. All costs, right? We can look at net profit, not just those costs of goods sold, but actually things like advertising, electricity, phone, internet bills, salaries for our CEOs, salaries for our reception staff, our admin people. These are all accounted for. We can have a look at our full profitability. These are published accounts. Anybody can have a look at these. Let's have a look at some of the limitations.
Show me.
It's a snapshot in time, and it's only showing the historical performance of the firm. We don't know what's going to happen in the future. It shows what has happened. These are actual recorded figures. They're not made up. They're not estimated. These are actual accounting figures derived from actual accounting information. But saying that, we can still use our data to forecast trends. Trends can still be forecasted from this data.
Show me.
What else? Window dressing, I should say. The legal manipulation of accounts to make them look financially more attractive. So window dressing can take place in the profit and loss account, and there should be things that any savvy business person should be aware of. So if we see that a sale of an asset is included in non-operating income, which would increase profits, we would be aware that this might not happen on a regular basis and is unlikely to lead to the same sort of profitability in following years. In fact, if you sell an asset, you may well be reducing your profitability in future. In this case, when an asset's sold, we call this, and it adds to profit, we call it low quality profit. So that'll be one-off profit that cannot easily be replaced, repeated, or sustained. You cannot keep continually selling assets to maintain profitability. So from the profit and loss account, we will be able to tease out low quality profit from high quality profit. That's profit that can be repeated and sustained if we know what we're looking for.